How do we determine when the bottom is in? And there's a 100% track record if BTC crosses the 200-day moving average and BTC crosses its short-term holder basis.
You have three of the best research teams saying the bottom is not in, it may be in, or it's definitely in. My view is that is the bottom in is actually the wrong question to ask.
Barring any big macro shift, I think we're still going to be range trading between 60K and 80K.
There was something in the news regarding SEC's rescinding some rules that they put like 20 years ago.
I think this is another step on us continue to see the agencies pushing forward, not only in terms of improving the market environment for crypto, but I would say the market environment in general.
If they don't modernize their rules, what they will start to see is more and more of US equities markets trading in dark overseas exchanges. As long as those accredited investor rules stand the way they are, you're going to continue to see the best opportunities go to the wealthiest 1%.
Nothing said on inflection point is a recommendation to buy or sell securities, tokens, or any other assets, nor does it constitute a solicitation or offer to invest in any fund, product, or financial instrument. This podcast is for informational purposes only. The views and opinions expressed by hosts and guests are their own and do not necessarily reflect the official positions or views of their respective employers or affiliates. Hosts and guests may hold positions in companies, funds, tokens, or projects discussed. Hey everyone. Welcome back to another episode of Inflection Point. I'm joined as always by Matt Hogan, David Lawant, and Michael Marc Antonio. This episode, I'm going to kick it off with something different. So I tweeted out recently that M&A activity in crypto had reached record highs. So this quarter isn't even done. And in the first 2 quarters of 2026, we've already eclipsed all of the M&A activity from the entire of 2025, which in itself was a record year as well. And the reason why I'm bringing this up too is because I wanted to bring to the attention that Blockworks and Messari are actually merging. So Blockworks has acquired Messari, and I mean, this is big news for me. We're combining two leading crypto media research and data infrastructure platforms to serve both sides of the market now. And so we're going to be helping asset issuers build trust and helping investors, platforms, AI-powered tools better understand and evaluate digital assets. And I think this leans into our mission towards bringing a more trust and transparency to the on-chain markets. So yeah, pretty excited to announce that here.
Congrats. It's a fantastic deal. Two powerhouses coming together to build the leading crypto data and media place. I'm really excited for it. Lots of good to come.
Love to see a fantastic acquisition. I can see the great fit. Messari has great products. And yeah, amazing to see what they're going to do in the bigger Blockworks umbrella.
Yeah, no, I love it. And then, so that's going on. I mean, it makes sense in this market with the M&A activity, lower prices, maybe a little bit more attractive valuations. Consolidation is part of it.
I think it's probably just beginning. I don't think that trend is going anywhere. There are a lot of companies for sale, a lot of activity in the water. You see this in every major crypto market cycle. You see a spike of consolidation and new leaders emerge, and it's nice to see Blockworks rising to the top here. And I suspect we'll see more M&A activity. I don't think that period's behind us.
Yeah, 100%. There was the Kaiko Amber Data, there was the Robinhood WonderFi, there was so many, I can't even list them right now, but the numbers speak for themselves. So yeah, let's kick it off. But before I see where we have two rival competing jerseys here, Argentina and Brazil. David, you're actually from Brazil. Michael, you're probably a Messi fanboy, if I had to assume.
I am. I'm originally from Brazil, and for those who don't have the video on, I'm wearing a Brazil jersey. This is the one from the Confederations Cup 2024. And yeah, World Cup is exciting. I plan to wear soccer jerseys between now and July 19th. Let's see which ones. I hope the Brazilian one as further as I can, but we'll see how far it goes.
Yeah, we'll get you a US Stars and Stripes jersey to put on as the US proceeds through the tournament, David. Don't worry. It's all good.
Oh, 100%. I'm already getting a US jersey. I hope to watch one of the games, and I actually have bets on prediction markets. I think my World Cup bets are doing better than my crypto portfolio. One of them is that the US will get to the quarterfinals at least.
That seems like a good bet. You weren't the $1 million bet on Spain, were you? Did you see that on
Oh man,
Polymarket?
that was insane. So
$1 million
someone put a
on
one
Spain
million
to win.
dollar bet that Spain would beat Cabo Verde, and I think he put the bet at like half through the game. The game was tied 0-0, 45 minutes in, and he just put $1 million. I think his best outcome would be to win $80,000 and lose $1 million. But yeah, we never know who's behind those things, right? So yeah,
Dude, there are better ways to make 80 grand with $1 million than that. That's for sure.
insane.
So incredible to watch. And kudos for whoever was on the other side of that bet.
It's actually interesting because Polymarket has triple the volume in terms of World Cup betting as Kalshi does. So even though it's happening in the US, you think that would bring some greater attention, but football, and when I say football, I mean soccer, is probably more of the other world kind of market. So I think it kind of makes sense from that angle.
So I don't know if we want to discuss the teams and all of that, but one thing I'm loving about this World Cup, I'm sure you guys are seeing all these posts from foreigners discovering America and going to Buc-ee's and Waffle House and saying how everything's huge in Texas. I'm just loving the vibe. I mean, it's been so great.
It's been a super fun vibe. Those are fun posts, and the atmosphere at the games is good.
Yeah.
It's been a great start to the World Cup. Really fun.
Yeah, 100%. I'm really liking this new extended format to kind of see teams play against each other who you wouldn't normally see. Bring some excitement instead of the same old that happens every 4 years. But yeah,
That's true. That's true.
Agreed. What a week for sports. Just an incredible week for sports across.
Yeah,
the
we
board.
got to talk about the Knicks. My Knicks.
So great, so amazing, well earned, overdue, beautiful to see. Not a Knicks fan, but was cheering for them, and great to see the city take it home.
A long time in the making.
Oh yeah.
okay. Lovely.
Was any of you expecting a 5-1? Sorry, a win in 5.
I was calling
like,
Knicks in
I
4.
it was gonna go much. It's gonna be much tighter.
No, the crazy thing was San Antonio basically had every game won, and then kept giving them away. I thought there was no way they would do that again in Game 5, but sure enough, they figured out how to do it. I guess it's youth and inexperience, but yeah, I was pretty sure it was going to at least go to 6. But kudos to the Knicks, right? They buckled down.
I
and
was
brought it
calling
home.
Knicks in 4.
Knicks in 4.
Oh wow, that
There's a true
Oh
fan.
yeah.
aggressive.
Oh yeah. Brunson is the man. He's the man.
He really is. It's great to see. It's great
He's
to
such a
see. And the Nova teammates, the whole thing is
It's
great.
such a good story because they were the underdogs. Brunson's a small guy, and in a era when everyone was talking about Wemby as the future of the league, and therefore saying to most kids, you got to be 7'5" to compete. Brunson coming in at, they say 6'2", but he's probably closer to 6'1" or 6 feet. And just such a humble, nice guy, being so dominant. It's really exciting. And being on the
Yeah.
ground in New York City, I can tell you, I've never seen the city happier than they are right now. And we really needed it because things have been bleak since COVID.
Very good.
Yeah, he's a great person to cheer for. Yeah, even as someone outside the city, it was great to cheer for Brunson. And the whole team. Team's really likable.
Lovely. Feel like a news program on from sports onto markets.
There you go.
So I mean, since last we spoke, the markets have recovered a bit. They're up like 7% in the last week. Nothing to write home about. I'm going to show a slide looking at BTC ETF flows. I mean, you can see that we're in this era of constant downflows. Yesterday was actually 80 million in the positive for BTC. So I'm hoping that this is the turnaround here. And I was looking for at the bottom, and I looked at how do we determine when the bottom is in, and there's 100% track record if BTC crosses the 200-day moving average and BTC crosses its short-term holder basis. And it was very close to doing both last month, but it failed to hit either, and that's why we're where we are now, 20% down. I was trying to look for another source, so we had this model at Blockworks, but my colleague Daniel Shapiro put out. It uses 100 different factors across stablecoins, options, derivative options, ETFs, and green shows that we're in the expansion phase. So this model in particular is highlighting that we have seen a bottom, but again, there's been a lot of breakdowns in models recently. Like BTC is no longer correlated to money supply; it's no longer correlated to the ISM. So the efficacy of these models, which have historically worked, is being put into question. But how are you guys feeling? Matt, we could start with you.
Yeah, I mean, look, the short answer is it's very hard to call bottoms. I read 3 great research pieces over the last week. One from Galaxy Digital, which said the bottom will be 40 to 50K. One from NYDIG, which said maybe it's the bottom, maybe it's not. And one from Standard Chartered that said the bottom is definitely in. So you have 3 of the best research teams saying the bottom is not in, it may be in, or it's definitely in. And I think that reflects what you said, which is this is a different scenario. Calling the bottom is very difficult. My view is that is the bottom in is actually the wrong question to ask. That the right question to ask is what is the top? Because if you think Bitcoin is going back up to 100K, 200K, or $1 million as I do, then the question of whether the bottom is 40K in Galaxy Digital's case or 59K in Standard Charter's case is irrelevant. Not quite irrelevant, but basically irrelevant. You want exposure. So I think people need to focus more on the question of is the top in or where is the top than is the bottom in. The bottom is really hard to call. It's probabilistic. My guess is we chop sideways for a few more months. But what I have confidence in is that the top is not in. And then indeed, we are going to get to new all-time highs because government debt is accelerating, faith in institutions is falling. All the OG reasons that we love Bitcoin are still increasingly true. The world is more digital. Young people are getting older and wealthier. All of that is still true. So my view is that the top is not in. And that's actually more important than the question of where exactly is the bottom, which is just hard to call.
Fully agree with that. The other thing I would highlight is that a lot of the Bitcoin price action now has been macro driven, right? The reason why Bitcoin is trading at 66K now versus 60K a week ago is basically because of the Middle Eastern conflict situation that got a lot better over the weekend. So there's a lot of these factors at play. There's also obviously we talked about this, the AI capital drag and the AI, let's say, adjacent themes, the giant IPOs and SpaceX. So there's a lot of noise in the market in the short term. I know I've been saying this every quarter or so for a while, but if you talk to any macro investor, he will say that this is one of the toughest environments to predict because there's just so many variables. Some of them are fundamental, some of them are strictly flow oriented. That is just very hard to predict what the market is going to do in the short term. Having that said, and we've been saying this, there is this buy pressure that seems to come whenever Bitcoin touches the 60K range or the 200 moving average level. You can see this in many different ways. You can see how the Bitcoin order book gets skewed to the buy side. I mean, if you work at a trading desk like us or Michael, the Galaxy folks, I'm sure they've seen a ton of buy activity from very large investors. Whenever Bitcoin starts to flirt with the 60K level, you start to see indicators like the Coinbase premium and some of these things kind of showing that there is very strong appetite for buying certain important corners of the market. So I would say that unless we have a big macro break, and this is a very big if, because again, there's a lot to happen. We're recording this on a Tuesday, as Kevin Warsh is heading his first FOMC meeting. We can probably talk a little bit about that. So there's a lot of moving parts on the macro side. But barring any big shift, any macro shift, I think we're still going to be range trading between 60K and 80K, which is what we've basically been doing since we started the podcast, and even a little longer.
Yeah, 100%. And I was looking to see if this macro was affecting all of crypto. Was it just a Bitcoin story? Year to date, there are 3 sectors in crypto that are up. One is perps, and if you look at the perp sector, it's only one, and it's hyperliquid. The second sector that's up is AI, is miners, crypto miners, and that's because a lot of them have pivoted to HPC, to AI. So they've jumped in that story, and it's almost no longer like idiosyncratic to, it's no longer correlated with crypto per se. And then the last category again is DeFi, and it's again thanks to hyperliquid mostly, and somewhat as well thanks to Morpho, which also just raised $175 million. Pretty big round. Congrats to them. And, Matt, you phrased it earlier as the question we should be asking is, whether we're in the top. And, there's local tops, there's more longer term, but then I'm looking at it for hyperliquid. Hyperliquid is approaching those again. And when I was looking at the ETF data, I saw that actually Bitwise's Hype ETF is the number 1 ETF by assets under management. So congrats there as well. But how are we feeling about Hype?
I mean, I feel extremely bullish on Hype. Whether the price is at an all-time top, market cap isn't, because there's been so much buyback, or at least it wasn't until recently. I think perpetual futures are still early in their journey. They're still a tiny fraction of global derivatives. They clearly have product market fit. They're winning every new incremental sort of challenge in the market, right? We saw huge volume in SpaceX perps around the IPO. I think it's all guns blazing on hyperliquid. I still think it has a long way to go. And I'll add, specific to the ETF, yes, we're very happy that BHype is the largest, most liquid hyperliquid ETF, but most institutional investors haven't even heard of hyperliquid yet, right? When I go talk to financial advisors or even family offices, there's very low penetration into that audience. So there's a huge part of the market that doesn't even know hyperliquid exists. So I'm bullish both from a flows perspective as they learn about this asset, and from a fundamentals perspective as it continues to win. Yes, it faces more competition. Yes, it faces regulatory questions. But look at the facts on the ground, which are just consistently winning market after market after market. Until that stops, I'm bullish, and the price is relatively contained versus the fundamentals. So yeah, I'm positive hyperliquid here.
Okay, love it. I know, David, there was something in the news regarding SEC's, looking at rescinding some rules that they put like 20 years ago, if I'm not mistaken, specifically 610 and 610E. Care to go into what they are and what the potential implications this are, specifically for like DeFi and AMMs?
Oh yeah, so it's a massive announcement. I think I would love to hear other folks' opinions, but I can just give a stab on what's going on here. So I think this is another step on us continue to see the agencies pushing forward, not only in terms of improving the market environment for crypto, but I would say the market environment in general. And I think this is a great example. So basically, just last week, the SEC announced that they want, this was a proposal. So they are proposing to re-sign the 2 Reg NMS rules. So that's Rule 611 and 610E. These rules were put in place, I think, in 2005. So they're like 20 years old. And the background around those is that they actually, there's a very nice introduction in the document, and they talk a little bit about the historical context of these regulations. And they were put in place in a market that was rapidly evolving. The market structure in the early 2000s, especially for equity markets, but I would say for the market in general, was changing a lot. I think it's kind of crazy to think now, but it was just over 25 years ago that we moved to penny wide spreads. Spreads used to be in quarter of a dollar. I mean, if you see those old quotes, right, you would see a number, let's say 25 and 3/8, 25 and 7/8. It was in the early 2000s that we moved to penny wide quotes. We started to see a lot of other innovations. The NASDAQ only became an exchange in 2006. It was already rivaling the New York Stock Exchange in terms of volumes, but it looked a lot more like an OTC market than an exchange. So there was all these changes going on. So it does feel like the SEC felt like they want to do something in order to improve the market structure and make sure that all these innovations that were taking place at the time would steer the market in the right direction. So that was basically the spirit of regulation NMS and these rules that were put in place way back in the day. What the SEC is arguing now is that a lot of these rules, while they were probably well-intended in the beginning, today they're more a hindrance than a help for the market. So basically, these specific rules that the SEC is proposing to resign, they are basically related to best execution guarantees that brokers need to provide to market players. And yeah, I don't want to spend too much time here, but in traditional markets, mostly in securities, right? This applies for equities, it applies for options. It doesn't apply for things like commodities or futures or crypto. But for a lot of these traditional markets, you have these best execution guarantees that basically ended up becoming a very strict set of rules that requires all these broker dealers to be connected to this huge number of exchanges, and they need to comply to this order that is just like a penny better than the other. So they end up kind of being counterproductive, and I think they have generated probably more market inefficiencies than market transparency and market efficiency. So a lot of things have been happening over the past 20 years. The market has obviously modernized from there. But basically, the idea here is to move from these best execution guarantees that are very strict and rules-based to something that is more principles-based and will sit at the broker and not necessarily operate within each specific trade level. So that's basically the change. I would say that this is important not only for crypto, this is important for the whole market. There's a reason why we have seen a lot of flows in equities moving from listed exchanges to off-exchange flows, right? So you have these dark pools, you have pay-for-order flows. A lot of these things are a consequence of a listed market that I think got too constrained and that had rules that at the end of the day were counterproductive for investors. But there's a very clear benefit here for crypto, especially for tokenized securities, right? This is where we're talking about in terms of best execution duties from brokers. To the extent that you are in the tokenized security realm, you have to comply to all the securities regulations. And things like KMMs, for example, they cannot comply to best execution rule because they're not aware of this external price that they need to comply with, right? So I think that's basically the idea here. The idea is to make this market more flexible so it helps the whole market, but there is a specific interpretation here for tokenized securities because it is a key piece of legislation that needed to be changed in order for us to fit a good chunk of the tokenized securities markets into the traditional rails. If I understand correctly, the proposal is going to go through a public feedback gathering process in like 60 days or so. Then they're going to vote on it. So it's probably something that I think is going to come online probably in the next few months. And I see it as very positive for the market.
Yeah. Let me add a few things on that. So 611, the rescission of 611 is the big one. This has been an issue and an enemy of certain members of the SEC, namely Atkins and Peirce, for years. Peirce has written about this pretty extensively, some of the issues with Reg NMS. 611 requires that any securities venue quote securities according to a protected quote, the best quote that's available nationally, which sort of in effect collapses all different markets into one unified market, but is very burdensome and difficult for different venues to comply with. And the rescission of that rule, and this is, I think, David, you hit the nail on the head. It goes from a rules-based system to a principles-based system. But what that really means is if you rescind 611, then the fallback rule is under FINRA. I think the rule is, I think it's like 5310 in FINRA, which is the best execution rule. And the best execution rule is not a black and white test. It is a bunch of principles that a quote needs to comply with, but they're contextual and they're factors based. There are no necessary conditions. There's just a much of sufficient conditions that a quote must comply with. So now it's going to be if this rule is in fact rescinded, it's going to be a more holistic test, which is definitely, to your point, David, good for crypto because, as you said, AMMs would struggle to ever list tokenized equities if they needed to quote those tokenized equities in accordance with a protected quote listed on a nationally registered exchange like the NASDAQ. For the reasons you just mentioned, David, 100%, AMMs are responsive to the market. They're not necessarily, at least today, leading the market in price discovery. And so they would never be able to lawfully exist because their quotes would always lag NASDAQ, or at least that is what we suspect. I will say a lot of people are framing the rescission of Rule 611 as a big step forward for tokenized equities. And that logic is that, an AMM can't comply with 611 because a bonding curve cannot respect the national best bid and offer. And so killing this trade through rule is a big step forward. And I think that's true. But even if that rule is rescinded, for AMMs to lawfully, under the current rules, list and trade tokenized equities, they'd still have to meet Rule 3B16. They'd still, which is the definition of exchange. So they'd have to meet the definition of an exchange under the Exchange Act. They'd have to register under Section 6 as an ATS. An ATS has to be operated, of course, by a broker-dealer. And so even if 611 is rescinded, there's still an uphill battle for AMMs to comply with the Securities and Exchange Act as currently written without the innovation exemption. So the whole hope here is that the innovation exemption can provide a blanket exemption from all of these different rules, or alternatively, that these rules are clarified with respect to crypto. But even the Exchange Act rules still provide for some, I think, anachronistic protections that don't really apply in a blockchain setting. So, for example, right now, today, securities must sit in a qualified custodian. If they trade on a blockchain, obviously they will not be sitting in a qualified custodian. They also must be maintained by a transfer agent. And so if an AMM is transferring tokens, where is the role of the transfer agent? A permissionless contract on chain can't be any of those things. It can't register as a broker dealer. It can't comply with the clearing agency. The blockchain is the clearing agency. And transfer agent transfers are going to be novel and unique and perhaps totally different. So I think there is still some room to go, but this could be a very strong step forward if 611 is rescinded.
That's a fantastic point by Michael. There's still a lot of hurdles to clear, and I think we're still on the same theme, right, Michael? We're clearing the easier questions, and we're moving forward. I think consistently here. There's a lot of requirements that would need to be filled for a decentralized exchange to fit in traditional rails. Registration requirements, compliance regimes, and all those things. It is a step forward, though. So
yeah, it begs the question: if there's a regulation that is meant to protect an inefficiency in the market, and market practitioners fix that inefficiency through technology, is the regulation still appropriate, and should the regulation still exist? That is the question of crypto, right? That is the fundamental question. If crypto is fixing through code and through technology historical issues that affected inefficiencies in the market, should those rules apply to those new technologies that have fixed those issues?
Yeah, that is the fundamental question. I would just add two things. I think this, for a lot of people, answers a tension that they've had in their mind, which is, why isn't this technology, which seems inevitable, just completely sweeping the market? It's because, I mean, just think about the numbers that were mentioned. 611, that's a lot of regulations just to get to 600, and 3B16. I mean, most people who are like, DeFi will win, haven't thought about Rule 611. There's just so much wood to chop between here and there. It's a reminder of why it takes a while. But I'll add the other piece, which is, and I'd be interested in Michael and David's thoughts, if you had to design a regulatory moment where it was possible to come over these hurdles, it feels like this is the necessary conditions, right? You need someone like Atkins, you need the current climate, they're willing to do innovative things. It's actually such a hard thing to imagine regulators doing in a short period of time, but this feels like one of the moments where it's not guaranteed but is possible, and maybe all the pieces, including Wall Street interest in tokenization, etc., are aligning to make this potentially true.
Absolutely, Matt. I will say that the success, and we can't pop champagne yet, but the success of the Genius Act with respect to stablecoins gave a lot of people confidence that modernization in crypto regulation actually can be a net positive for all markets. And so, on the tailwinds of the Genius Act and the wide recognition that stablecoins are a tremendously beneficial technology and that they should be brought into the light and under US jurisdiction, I think the SEC is both being very, very innovative and also very practical, because if they don't modernize their rules, what they will start to see is more and more of US equities markets trading in dark overseas exchanges, and more US persons being subject to regimes that they themselves, the SEC, does not have any oversight over or jurisdiction of. So I think it's a perfect time, but it's no coincidence given when you see the Wall Street Journal talking about hyperliquid, how it's traded over the weekend. The SEC has to start thinking about, well, if equities perps become significant enough on hyperliquid that they impact US markets, there's a problem with the regulations pushing hyperliquid overseas.
Yeah, that's the remarkable thing about this moment. You've seen over regulation restricting the market in multiple ways, and you see the market working around it, and it's forcing regulators to adapt. The other example was all the efforts to gain exposure to private shares, whether in traditional systems or in crypto native systems, a clear response to the massive difficulty of being a publicly traded company. And sort of the market is curing itself, and crypto is playing a key role in that. It's kind of fun to see from an ecosystem perspective.
One other thing that I think is not talked about enough is that the default rule in the United States for my entire lifetime, all of our entire lifetimes, has been that if retail, if mom and pop, if widows, widowers, and orphans, as my securities regulation professor would always say, if they want to buy a security, it must be registered as a public security. And that worked pretty well when capital markets were relatively thin and you needed to be a publicly traded company to raise real capital. In today's environment, it is an outrage. I think people will look back on this era as outrageous that retail could not buy the most important securities that are affecting our economy, namely Anthropic, OpenAI, SpaceX, that they could not buy them lawfully for their own protection under the current rules. And that only accredited investors and institutions had access to buying those stocks when they were private. These securities are as important, not just for our economy, but for our political system, right? And the more publicly owned they are, I think the more democratically controlled and run those companies will be, and the more legitimate those companies will be seen in the eyes of the public. Because right now, Anthropic and OpenAI, they have some serious political issues with Gen Z and with millennials that they need to address, and them being private companies still is I think a big issue for them. So that's why, of course, one of the reasons they're going public. But by the time they go public, they're already trillion-dollar companies. The SEC, if these are trillion-dollar companies today, the SEC really has to take a hard look in the mirror and say, what about our rules did we get wrong here? And so I think that's an important piece.
100%. While you guys were talking, I was looking for this stat, which is in the SEC document, in this 610 and 611 Regular Mass proposals, rescissions. They themselves were saying that in 2005, which is when these rules were approved, only 13% of the volume of the New York Stock Exchange happened off exchange. In 2026, this number is almost 50%. And a big part of the reason why this happened is because what Matt and Michael were saying, because the market finds a way around it, right? You end up finding solutions to get around these constraining factors. The issue is that a lot of these mechanisms, they sometimes will benefit a few select companies or a few select insiders at expense of a much broader public. But I think it's great to see that we're seeing progress. One other topic that I think kind of is tangential to what Michael said is that, and Brian Armstrong just tweeted this yesterday, is that investor accreditation rules in the US, they should probably be revisited. It does feel like this is a little bit of a very unanimous topic. I have never seen anyone who agrees with the state of our accreditation rules. So there's a lot of improvements to make, and it does seem like this SEC administration is the one who's willing to tackle them head on.
If you're a PhD in finance, adjunct professor, making $60,000, $80,000, $100,000 a year, you are not an accredited investor, and therefore you are not competent under the current rules to buy private securities. And that's crazy, because if, in this example, you're a PhD in finance, right? You are smart enough to make these decisions yourself. So, of course, to be fair, these rules were born during an era when knowledge was not widely distributed. It was before the internet. It was before even most people had access to the basic things that you need to make a prudent investment. But those days are over, right? I mean, you don't need to be a PhD in finance to be a prudent investor today. And so I think as long as those accredited investor rules stand the way they are, you're going to continue to see the best opportunities go to the wealthiest 1%, and the 99% get crowded out. And maybe the 99% would have dealt with those rules and that economic inequality in good times. But if AI is going to be as prolific as we all assume it will be, and starts displacing jobs, it's going to be quite a black mark on the regulators' records that the people whose jobs were lost could not own those very stocks to cushion the blow that had happened, that will happen.
That's really fascinating. So to kind of summarize, it's basically there are these different grocery stores and they have to do price matching according to Rule 611. And it's very hard because they have to see what the grocery store in another state is quoting it at, and it becomes very cumbersome. So instead, they've opened up these rooms in the back where they say, we don't have this in stock here on the shelves, but you can go in the back rooms and now you can purchase it over here. And like David was saying, the SEC's own admission is that these back rooms have become just as large as the grocery stores, as the front ends were supposed to be. And so this is not just specifically a win for crypto, specifically the AMMs. It's also just a win for the market in general. And then it's one of the many symptoms of these old laws that are now having serious consequences for investors and exchanges alike that need to be changed. And this is just probably the first step of what likely needs to be many more changes in order to bridge the old economy with what the markets are reflecting now.
Yes. I would add that the 611, as it currently exists, creates significant fragmentation because anyone can spin up a venue, but not have to provide meaningful liquidity in order to get the best quotes from other exchanges that do have that liquidity. So this fragmentation is costly, but of course it is costly on the exchanges where liquidity is provided. It is also costly for regulators to have to oversee and comply with. And the smaller venues that are fragmenting the liquidity are being subsidized in effect by the larger venues that are providing liquidity.
Yeah. Just a small detail here. The reason Michael is talking about 611 specifically, because this is the rule that avoids like these crossing orders being executed. The 610E, which is the one where we're not talking too much about, is the one that that prohibits you from even providing quotes that are crossing the protected, the national best bid, ask, and offer price. So one is about showing quotes to the market. That's the 610E. And then the 611 is the one that actually prohibits you from trading across the national protected price.
And then, Michael, you were saying that if this were to be rescinded, there's still a fallback. I can't remember. You said 53. You said so many letters and numbers. I'm losing track. But there's still existing regulations that can be as a fallback, which is more like holistic based, more instead of rules.
5310. It's a FINRA rule that all FINRA members need to comply with. Now, I think that this is not issueless, okay? Because FINRA rules imply that you need to be a FINRA member in order to make markets in securities, which is itself a burdensome standard for market makers to comply with. But putting that aside, the FINRA rule is a principles-based rule. It has 5 or 6 or 7 different conditions that a best executed quote can comply with. And it's a holistic query that takes into account market conditions and a host of other factors.
Okay, and this is why it would be a lot easier with the SEC, well, the previously proposed innovation exemption, which I don't know where we stand on that right now. It's been pulled back or delayed, and I don't necessarily see any information of when it's going to be resumed, but that's probably the biggest regulation in terms of market structure that we could hope for tokenized stocks, at least in the near term.
Yes, that is a very important one. Now, to be clear, the reason why that's so important is because of all of these other rules that we could spend hours talking about that AMMs or even small crypto native market makers cannot even hope to comply with. Right now, and over the last 5 years, we've been living in the golden age of market making. Anyone can be a market maker on Hyperliquid. Anyone can be a market maker on Solana or on Ethereum. It rewards the best quotes, the fastest execution. But in the equities world, they can't even get a foot in the door if they're not a registered broker dealer. And a registered broker dealer effectively requires an entire compliance arm. And to comply with the broker-dealer rules is very significant. And so you need a sledgehammer, in my judgment, to cut through all these rules for a brief period of time to just see if they can work without the rules, to see if innovative technology actually has solved a lot of the things that these rules were meant to address.
Okay. This is definitely something that's probably under discussed. And like Matt was saying, when we just think about the technology side of it, like, oh, AMMs are great, they're permissionless, they can do this without any licenses, registries. But at the end of the day, those regulations are needed, especially if we say, the institutions are coming, and if that mantra is to be believed and their flows matter, then the regulations matter even more. So yeah, definitely important. Um, on a slightly different note, and I don't know if I don't think regulations can help with this. I was looking at some data, and Q2, and I'll just pull it up here on the screen. Q2 2026 was actually the most number of hacks in any quarter ever, and it's not necessarily highest dollar value. I mean, there was this L2, this gaming L2 that was got hacked by North Korea a couple of years ago. That was a large dollar amount, but it's the number of hacks happening that are concerning. And this inflection in Q2 specifically, I can't help. I don't have any data I want to dive into it more to see what the causes of the hacks were. Was it key management, or was it like smart contract bugs? But I have to believe that this is AI related. And I remember we spoke about the threats of AI to DeFi like a couple months ago in an episode, and I was saying it seemed like DeFi was the first target. It was the biggest honeypot. It was the most untested, and the blockchain. It's immutable. So I don't. Do we have any? We said AI. Sorry, we said that DeFi was coming back. It's going through this moment right now of hardening, and every hack makes everybody else stronger. But have the dynamics flipped here with AI? And should we expect, or are you all expecting this number to increase even more in Q3? Or do we think that actually, now that the genie's out of the bottle, so to speak, in terms of these agents, that they can actually be used as the white hackers or used on the defensive end of it? Yeah, anybody with any thoughts there?
So the hacks that happened in Q2 were pretty significant. Most of them, if not all of them, were not the result of bad code or flawed code. If it was, I would say you're right. It has something to do with AI. Um, it had to do with human error or key management, or in the case of Drift, a complex, sophisticated, almost espionage level North Korean operation. Now, securities that trade on chain solve a significant problem that crypto has faced with these exploits and with these hacks, because securities on chain will increase the value of non-bearer assets on chain. And non-bearer assets are important because if they are robbed, if they are stolen, if they are the subject of an exploit, the issuer can just burn them and reissue them to the proper party, thereby reducing the value of any potential exploit. If you steal, let's say Drift, when the Drift hack had happened, they had stolen a $300 million worth of Tesla stock issued by Ondo. Ondo would not let them just trade that Tesla stock. It would just burn those tokens and reissue them, right? It would be a very simple issue. And so I think this will change as more real world assets get on chain. But yeah, for bearer assets, it's going to remain a problem. And I think AI does pose a potential problem in the future. I don't necessarily think it was a problem for the last quarter.
Interesting. Yeah, I fully agree with Michael in that. I mean, kind of a feeling, but it does feel like most of the hacks were not related to smart contract code, but they were mostly related to key management issues. The two things I would say here is that first, these are the centralization points in a decentralized system. So a lot of the problem here exists because there's a relatively small number of players, in some cases just one player, that has this admin key that can exert a lot of power over the protocol. So I think a lot of the problem has been in these centralization choke points. And the other thing I would say, I don't know, maybe this is just a low-hanging fruit. Maybe folks are using AI to go for the easier hacks. But at least so far, I've been kind of encouraged to see that AI hasn't been able to find any catastrophic bugs in the blockchain smart contract codes itself. Let's see how things go, how things evolve. We're definitely in a transition phase. To me, two things are clear. Number one, we're going to be in a much better spot, let's say 6 to 12 months from now. I don't know what the exact timeline here is, but once we survive this transition phase, we're going to be in a very good spot. The other thing, and I would agree with Michael here, is that the next 6 to 12 months can still be rocky because we don't know, right? These models are kind of getting launched and then they get pulled back. So we don't know how much of their power is already out there exploiting every single bug that can be exploited. Also, the defenders will also start to use those models to protect their own systems. So I'm very sure we're going to land in a much better spot. I'm still cautious from between now and the path till there, which could be 6, 9, 12, 18 months. Hard to tell at this point.
Yeah, I think you guys are technically right about them not being AI driven, them being human flaw driven, but practically wrong on the impact. I think the world is freaked out about AI cyber hacks, right? We just had Anthropic pull Fable from the market. There's a huge amount of hype and fear. So the fact that we had such a large quantum of hacks at the same time that people are panicking about AI leading to more creates risk that we're like one AI driven hack of DeFi from a really big collective freak out. So I do think there is a real world element of what's going on. I like David's long term optimistic vision, but I don't want to see a major hack of DeFi in the near term. I think that would be confidence damaging, particularly for institutional adoption of crypto. I think we have to be realistic that that's one of the material risks, just because there's so much societal level freak out about what's going on with Mythos and Fable and potential hacks. I think it's raised the level of concern.
I agree, Matt, 100%. Nobody wants to see other hacks in DeFi. And I do think that Mythos or Fable, and we haven't even mentioned if China open sources a model as powerful as those, right? I mean, Anthropic can safeguard and pull their very powerful models, but China is, not that far behind on any of these models, and they open source those models to undercut US markets. So that could be an issue. But I think it's worth noting and repeating over and over again that the hacks that we see on DeFi are so visible and so widely discussed because DeFi is open, public, permissionless. And we don't know how many hacks have taken place in private markets outside of crypto that lack total transparency, right? And so the reason why we see exploits that feels like every quarter you see some new big exploit is not because, in my judgment, crypto is uniquely risky. It's that it's actually uniquely safe in that if there's an issue, you and everyone else sees it on chain. And the reason that's a benefit, I think, in the long term is that when a new model comes out, when Mythos comes out or Fable comes out, or when a new protocol is launched, every person in the world can underwrite that code and can fuzz that code and try to understand if there's any vulnerabilities in that code. And while in the short term, that creates vulnerabilities and potentially exploitable risks, in the long term, it actually creates overall fortification of these protocols. I remember in 2022, there used to be exploits every single day. I mean, if our audience is interested, go to rekt.com, REKT, Google it. It is a great website that chronicles all of the exploits in DeFi. And there used to be so many of them that took place, and they were very complex, very sophisticated, and very damaging. But those types of exploits that happened in 2022 don't happen today, because people learned the hard way about how to structure and design these programs on chain, and they were able to correct those issues long term.
Yeah, that's fascinating. I'm having my model look through the data right now, and they're saying a lot of the last 77 hacks, and I'm getting this data from DeFi Llama, by the way. 63, let's just talk percentage. 80% have been protocol logic, and 12% have been private keys compromised. So, what does protocol logic mean? I don't really understand. I'm not a cybersecurity expert, but I don't
What
know.
is the
To
dollar
me,
value, though, right? Like, so,
Yeah, number of
yeah.
dollar value, just because I think the biggest hacks recently were the private keys, so the dollar value is going to be facilitated towards
Right.
that. But I was more looking at the number of hacks, because I think, and we have more poison addresses now. I just think that it's just becoming maybe easier. Maybe you can use AI to get to smaller protocols that, like, we've never heard of or never looked at before, from entrepreneurs who are new to the game. It's hard. I mean, everything that you all have said made sense, but it's just hard for me to believe that this spike is a coincidence. Just like everybody's getting their private key compromised at the same time. But then again, like I said, I'm not a cybersecurity expert, so I don't know. But it's still fascinating. Maybe next week I'll have a little bit more nuanced data
I
to
mean,
report back with.
you're Mark. I mean, I don't disagree. When you look at that chart, it doesn't seem like that could be a coincidence. So I agree with that. I actually think that I don't know how useful that metric is, because I think what we care about is like big established protocols getting hacked, not brand new ones that
Yeah.
there's no liquidity or volume on it. But yes, I think that this is something that is very serious.
Yeah, hacks are bad. Aave almost broke. I mean, it's been a bad stretch, right? Like super bad. It needs to be less bad in the future.
No
There's my
question.
sophisticated analysis. Super
No
bad.
question.
Needs
But
to get better.
but I think Michael has a good point, because I mean, we're gonna continue to see these small hacks. I'm looking at the DeFi Llama database, and you have a bunch of hacks that are for $10,000, $50,000 here or there on a protocol that you've never heard of. I think those will probably continue to exist. The question is whether we're going to see the Kelp DAO and Aave Contagion type hacks that we already covered extensively. These are the ones that really hurt, and these are the ones that I don't think we can see anymore.
Yeah, I mean, banks used to get robbed all the time, and then technology advanced, and now banks don't get robbed that often. And this is a brand new industry, a brand new market, and these exploits are the equivalent of a robbery. And so that's going to happen at first. I'm not being flippant or dismissing it by any way. I just want to contextualize it, that if I were to ask you, Mark, the same question, how many traditional institutions over that period were exploited, you wouldn't be able to find any data on it. But that doesn't mean that none of them were, right?
Yeah, that's a good point. Yeah, and probably a lot smaller ones too around the world are always getting attacked, and but they're not large. They don't have to report it. Some of them don't even know it happened. So yeah, it's a good comparison. Um, I'm just going to end it on one last note there, because this is something that excites me specifically. I saw that the SEC is approving for the first time an actively managed multi-asset crypto ETF. Um, and I used to work in the ETF space like you, Matt, and this is something I've been waiting for many years now. I'm finally glad we have it. Gives investors a way to get exposure to multiple assets at the same time with active ETFs. So there's some kind of attempt to get some alpha behind it as well. And I don't know. I think it's probably for maybe younger investors who want to get exposure to this, it's good to have maybe this as some percentage of your portfolio, because I'm always being asked which ones to buy, which cryptos to buy. Most of the time I reply S&P 500. Just by, if you're asking me which cryptos to buy, you should probably just stick to a stocks index fund. But these kind of entities might be more suitable for retail.
I think it's great for the market. It also, hopefully introduces a sound voice who is out there with positive views on the market. That's one of the things that active managers do in the equity space is you have uh Kathy Wood talking about Tesla, hundreds of dollars ago, pre-split. And that's important for the market cycle. Look, any mature market has both active and passive funds in it, and they both play a key role. I'm excited to have the, Peter Lynch of crypto emerge from one of these active managers. God bless. And I think it'll be great for the space. So happy to see it.
Do you think that this is going to look like the traditional active managers, dominating, or is it going to be a new class of active managers? Do you think?
I think everything indicates it'll be a new class of active managers. If you think about the great active managers, they're specialists in one area, right? Like it was Bill Gross in bonds. Bill Gross didn't do stocks, he didn't do commodities, he did bonds. Peter Lynch did stocks, Kathy Wood did innovation. It's not typically born, but I think it's idiosyncratic to the individual, actually more so than the firm. It's really about who has seized the mantle of this and who makes the right calls and gets a name. And I'll introduce my index bias. I think it's somewhat random. Like most active managers underperform over time, but sometimes one catches lightning in a bottle. So I think it's idiosyncratic to the individual, and whether they catch lightning in a bottle with their first few allocations will determine sort of who ends up on the cover of Fortune as the Peter Lynch of crypto.
Next. The other thing I want to highlight is that the asset manager that got the ETF approved is T. Rowe Price, which is one of the largest ETF issuers in the US. Very interesting to see that they went for an active management strategy straight out of the bat and not for an indexing or single asset strategy. The list of assets to me is still a little bit constrained because it feels like they're more concentrated on the crypto commodities basket. So things like BTC and Sol and XRP and Cardano, Avalanche, and things like that. I don't think things like Hyperliquid, for example, are yet in the approved asset list that they have mentioned in their documents. But again, this will definitely come with the maturation of the market. I know Blue Messari from the T. Rowe Price team. We should have her over as a guest. She's amazing. Very, very excited for what this team is going to do here.
Yeah, she is amazing. It'll be really interesting to see how much active share they take. Crypto is a very challenging market because it's so BTC dominated that the degree of active drift you can take can be truly massive, but that's also risky. So it'll be fun to watch. But I agree, the team at T. Rowe is excellent. Blue knows the space extremely well, and excited to have them in the mix.
Amazing. The other thing I would say is that I think it was just yesterday that BlackRock's Bitcoin covered call ETF listed, and I think there's one by Goldman Sachs coming soon, which is also it's another active management strategy, right? So here we're not talking about active stock picking. We're talking more about like this active synthetic yield extraction strategy, but it's also an active strategy in the sense that you need to be aware of the market regime. You need to size your positions. You need to select the instruments. So overall, I think it's been a very good week for the crypto active management complex.
Okay, love it. Another good week for crypto active management regulations, and luckily 2 prices. We're on time there, everybody, so I'm going to call it. Thanks for joining me, and for listeners at home, if you have not yet, please subscribe, like, 5 stars, all of that good jazz. It really helps the show out a lot. But yeah, thanks again. Thanks for listening. And guys, I'll see you next week.